Ladies and gentlemen, if we could please find our seats, we'll get our program moving forward. Well, to start off our program, I'd like to say thank you to all of our sponsors. We couldn't be doing what we do up here without the sponsors. What's interesting is today's program is Beyond the Banks, and we know that a lot of our sponsors are banks, so we appreciate your sponsorship and your engagement in CCIM. If you are a sponsor or a designee, on November 9th, we are having the sponsor designee event. That is at Flight Club. And after Flight Club, we are heading over to the Sphere and getting a tour and presentation in the Sphere, which should be very exciting. So if you are not a sponsor yet, there's still time. Education. We are currently running a CI 101 class, which is amazing. We have over 40 people signed up and attending that class this time at LVR. So super excited about that. And we also have our regional conference coming up in October in Seattle for CCIM, our annual governance meeting, and there's a test. We have quite a few people from Southern Nevada and Northern Nevada testing, so we're very excited to have that portion coming up. All right, and now on to our panel. Our moderator today is Andy Crawford. Andy is Senior Vice President of ComCap Advisors, responsible for new loan originations through life insurance correspondent, agency, CMBS, and other institutional lenders. Andy has a very long resume, which he said, please read every single word of it. Andy has been on the board for many years. He's been very active with our CCIM Southern Nevada organization. He's a family man. He loves to get out into the community and donate his time to the community. So this is Andy Crawford. Thank you for agreeing to moderate this panel on Beyond the Banks.
Thank you, everyone, for coming. We are excited to talk about a topic that is near and dear to my heart, because that's my career, but also affects anybody and everybody in this room who's trying to do a commercial transaction. So I'm happy to bring up my panelists. I can have you all three come up together at once. We've got John Loshbaugh, who's Senior Vice President of KeyBank, based in Orange County. We have Betsy Kern, who is Senior Underwriter of Standard Life or Standard Mortgage Investors, Standard Life Insurance. And then we've got Bob Farah of Battleborn Capital, local hard money, private money lender here. So we're going to take a seat and have a general conversation here. Flip on each of these. Not flip them off. I'm told that's bad. So I want to go down the line here, give you guys 30, 60 seconds to talk about how you got to where you are, what you do, and just keep it light or keep it quick there.
Fair enough. So as Andy mentioned, I'm with KeyBank. KeyBank's a $200 billion regional bank based out of Cleveland. About 30 commercial real estate offices nationwide. I'm in our Orange County office. I lead our off-balance sheet production efforts for the Southwest. So Key has not only a traditional commercial real estate balance sheet program, very focused on kind of our off-balance sheet capital markets platform as well, which is where I sit. That's primarily CMBS and agency, so Fannie, Freddie, FHA products. We do about $11 to $12 billion in production a year. In that platform, the platform is focused on all asset classes, heavy concentration in multi, but also still doing office, hospitality, storage, manufactured housing, retail, et cetera. Generally 5, 7, 10-year fixed rate, non-recourse loan.
Standard Insurance is a life insurance company domiciled out of Portland. We are a wholly owned subsidiary of Meiji Yasuda Life of Japan. We are a portfolio lender when our current portfolio is about $15 billion. We are fixed rate, anywhere from 3 to 20-year terms. We do recourse, yield maintenance. We do deals all throughout the country through our correspondent network. We do all asset classes. We do a lot of retail, industrial, some multi, and some office. We close all of our loans in-house without legal counsel. Our loan size is from 1 to 20 million with an average loan size of about 5. And we are still actively lending.
Hi, my name is Bob Farah. I'm with a company by the name of Battleborn Capital. We're a private money lender here in Las Vegas. We do we've got a small portfolio, nothing like 200 million. We're just under, well, I think we've got about 90 million out on the street right now. What we do is we raise private money from an investor base. The range of size of our deals, so we'll do the realm. We do real estate, everything's real estate secured first position, and we go to our private investors to fund those deals. So I've been with Battleborn Capital for 2 years. We're growing the company. Our deal size ranges anywhere from $500,000 up to $25 million. On the $25 million that we did last year, we had one investor that took the entire note. Everything is, we look for guarantees on these deals, but I've never been successful in going after a guarantor, so I don't know how much strength there is to that. So we look at the collateral value first, then we look at the other factors like the conditions in the market, character always number one. So when you hear of private money or hard money dealers, typically there's not a good name associated with it. Because a number of people in the industry from time to time
Bottom feeders.
have spent time behind bars. So,
Yes, there's a perception sometimes of the hard money if they're just lending to own. They want to take the property from the borrower, and that's not the case for most of them, but a few of them spoils the whole batch. So for those who do not know me, my name is Andy Crawford. I am Senior Vice President for ComCap, Commercial Capital Advisors here in Las Vegas. Offices here in Reno, and Boise. We're a commercial mortgage banking firm that works with all of these lenders to arrange financing for commercially backed commercial real estate backed debt from 2 to 50 plus million. And we work all throughout the US. So thank you all for coming. And I want to start with an easy question that interest rates seem to have gone up a little bit in the last few months or couple of years, and 10 minutes, yeah. When's that going to stop? Because it keeps killing all our deals here. So whoever wants to go first.
Well, obviously, no one knows, and none of us, as lenders, we get asked that question all the time. And the favorite response as a lender is, if I knew the answer to that question, I wouldn't be, slinging real estate loans. I'd be sitting on a beach somewhere. But I think if we look back a year ago, we had a number of people talking about, the Fed was going to just crush the economy, and we were going to have rate cuts coming soon, and we were going to be back to 3.5%, 4% money, and everything. This was going to be a quick fix. I think we've seen that Powell and the Fed have been consistent in their message recently that this is not something that's going to happen quickly. They're going to be very data driven, and I think up until 2-3 weeks ago there was still quite a bit of consensus in the market that 2024 we'd start to see some rate cuts. The extent of which I think was still up in the air, but I think within the last week or so, the sentiment has changed that 2024 may not have a rate cut, and if it does, it's going to be at the tail end of the year is what the futures market is pricing in, at least. So
with the potential of one more rate increase before they cut again.
Yeah, and there had been the futures market is what a lot of traders look at to kind of gauge the market sentiment on those rate hikes, and there was a pretty high consensus around a fourth quarter, that last rate hike, and there's now talk that they're going to push that hopefully last rate hike into first quarter of 24, so that they have some more justification for not having a rate hike or a rate cut until we get towards the end of 24, potentially even into 25.
What he said.
One of the things, we've had 11 rate hikes since, I believe, February or March of 2021. We've got 2 more meetings before year end. I think we'll probably see 1 rate hike. But I got to tell you, just like you said, nobody knows. We're all sitting here guessing what's going to happen to the market. I'm old enough where I remember when prime rate was 21.5. And right now, prime rate, we haven't seen it this high since 2001. So it's anybody's guess as to what is going to happen. But a funny story, this is the 3rd time I've been to one of these CCIM gatherings, and thank you for having me. Back in 2009, after the big crash in '08, most of us remember that, the question came up, and Andy was kind enough to give us a list of the questions before we came here. We didn't have that luxury when I sat on the panel before. And the question was, if this was a Major League Baseball game, what inning would we be in? And I said, like a dummy, 7th inning. Well, if people had tomatoes, they would have thrown them at me. So I'll just tell you, whatever I say, don't listen to it, do the opposite. But the research shows that we're mirroring what happened in the late 70s, early 80s. Not as high, but I can definitely see a pattern with the inflation and the economy that goes back 40 years.
Thank you. So kind of to build on that, we titled this panel Beyond the Banks. As Paul said, many of our sponsors for the chapter here are banks, and they're a critical component to the market that we have here. They fund businesses, C&I lending, commercial real estate lending, all across the spectrum. And they have been very active, very aggressive over the last 5 years. Up until first quarter of this year, we started to see some trouble on the horizon. You have the Signature Bank and Silicon Valley Bank issues, failures. And what we really wanted to bring to this discussion or to this audience here was the educational aspect that there is more than just banks out there. These represent the really 3 main alternative sources of capital in the market. And when we say alternative, that doesn't mean small. It just means not banks. Banks make up a huge portion, but if you guys can just briefly discuss what your respective capital sources, the conduit agency, the life insurance, and the private, if you've got the overall numbers, what proportion or what volume of a general year of lending volume that would be useful for putting that into perspective?
We are going to do about 3.2 billion this year. Last year we did just over 2.7. We're going to close around 650 loans with our average loan size of about 5 million.
And how big is the insurance? Do you have that number roughly? Just life insurance lending in a general year? No, that's fine.
I don't know the whole.
Okay. Generally, we're talking probably, 3 trillion or so, in that ballpark. It's a big number.
I don't have all these numbers right in front of me, but I'll kind of split it a little bit. So, like I said, KeyBank, our what we kind of call our capital markets group, is kind of split between multifamily finance, which is Fannie, Freddie, FHA, which is a huge driver in the market. That Fannie and Freddie are capped on an annual basis at $70 billion in production each. Big numbers. They will not hit those caps this year. They'll be well short of it, but still combined between the two of them, they'll do well over $100 billion in new loan originations this year. KeyBank will do somewhere in the neighborhood of $10 billion with those with Fannie and Freddie. FHA is another. Be tough to give you a real accurate number, but it's a $10 to $15 billion a year production figure for on a national basis. The CMBS market, which is where we do a lot of our commercial business, since Fannie and Freddie are only active in multifamily and manufactured housing. That world has, will ebb and flow between a $100 billion a year national production number. It's going to close this year well below that, just given where rates have gone. But still a very, very vibrant market, very active market. I think, one thing we're going to talk about up here is all these sources of capital. While the banks, a lot of banks are constrained and, reluctant to lend money to people outside of their best relationships, there's a lot of capital in the system. The capital markets, which is a lot of what we represent, there's plenty of capital. It's not always at the pricing today that people want, but this is not a situation like 9/10 where there was no liquidity in the market, there was no capital. There's a lot of capital out there, and so it's good to talk about, when not everyone is chasing the same deal, where the best fit might be.
Right. And if there's one takeaway we have from this panel discussion is this is not the depth of the recession. This is not where we are having the lack of deals out there is not because we can't find money for them. It's because the economics between what that capital costs and what the deals are able to support don't line up at the leverage point that borrowers need in order to hit their yield numbers. So that's the mismatch we have right now, and that's going to take some time to even out, as whether that's cap rates expanding or rents going up to make those numbers, those economics work again.
If I could just add, the private money business here in Nevada, there's about 5 or 6 good players. What I mean by good, they're doing deals. And at one time, it was $1 billion a year or more. That's changed quite a bit since the regulations changed in 2010. A lot of people dropped out of the business. There's people that got back in the business. So I was in banking for 14 years. I got out of banking for 14 years into private money. Then I got back into the hard money business back 2.5 years ago, but I spent another 12 years in banking. During that time, you saw a lot of companies close their doors because of the net worth requirements. So the statutes have changed quite a bit. There's testing now, as we all know. At one time, there was no entry level. There's no threshold to get into the business. Now it's a lot more legitimized. And I would think that the private money industry will grow here simply because the banks are so constricted and so overregulated, in my opinion, that it really creates a niche market for us.
So can we talk about, and we'll start with Bob on this end, but can we talk about who the ideal borrower is for your respective bucket of capital? What draws somebody to doing a private money or a life insurance or a conduit CMBS agency type of deal?
If I could. People that need money quickly, they want to close quickly. We work off of appraised values. That's not always good. Remember what happened in 08, 9, 10? It was a disaster. We're a little bit more educated, I think. We've got great business partners with our title companies, with our appraisers. We don't have high concentrations like we've got concentrations, but we're certainly not as regulated as the banks are with their concentrations.
We cater to the borrower that wants to hold on to the property long term. We offer fully amortizing up to 25-year loans. And we are recourse, so we need to make sure that the borrower is okay with that. And we are yield maintenance, which is different from the bank, hence the long-term holds. Since we are the 1 to 20 range, we are smaller strip retail, small suburban office, smaller apartments, small industrial, but there's a lot of those types of deals in this market. And we also do require a guarantor or a warm body on all of our loans. So if there's, if they're comfortable with all those pieces, then they're totally a life company borrower.
And have the substantial net worth requirement.
Substantial net worth, and we do also have credit score requirements, and we do run the background check for public, filings and stuff like that.
So I'll speak about both CMBS and the multifamily finance world, the agency world. So on the CMBS side, our typical borrower, the main differentiator is CMBS is non-recourse. So it's typically long-term holders. CMBS has traditionally been a 10-year, focused around 10-year loans. We're doing more 5-year loans these days because of rate expectations, but it's typically commercial loans that borrowers focused on non-recourse and fixed rate. We'll do deals, like to be above $3 million, but right deal we'll do as low as $2 million. And CMBS deals, there's no real upside to the highest loan amount you can do. We've done $1.5 billion single assets, and we've done everything in between. On the agency side, it's again a non-recourse product. It's generally fixed rate, although there are floating rate options there as well, but heavily dominated by fixed rate. High leverage compared to a lot of other lending sources at very market leading pricing versus other capital sources.
And then you said on the minimum for your conduit, the CMBS, that's $3 million that really starts to make sense.
2 or 3 million.
There's a pretty high fixed cost of getting all the third-party reports and studies and lender legal that when you have $1 million or $2 million deal, the percentage of that just gets non-economical. You might be paying 4 or 5 points to get a deal done like that, whereas that goes down to 2 at a $5 million deal or a $50 million deal. It would be even less.
And if you're willing to sign recourse, Betsy can do $1 million deal with in-house legal and much lower costs. But sometimes we have borrowers that just insist they need non-recourse.
Yeah.
And so
sometimes non-recourse is the hot button there.
Yep.
So, is everybody familiar with the recourse non-recourse distinction? Where there is a personal guarantee for recourse, if there is a loss to the loan or to the lender at any point of that life cycle, they can come after the borrower directly for that. In a non-recourse, as long as you don't break any of the bad boy carve-outs, you throw it into bankruptcy, you put hazardous waste on it, you don't insure it, or you steal from that property, you can just hand the keys over and do your best and give all of the proceeds of cash flow over to the lender servicer, but there's no personal recourse for you to walk away. So for those particularly who got hurt in the last serious downturn, they don't want to get back into a full recourse situation. So that non-recourse is attractive when it fits. And what you find is that's going to be a higher debt coverage ratio requirement, a lower loan to value. Because they're only looking at the operation or the net income from the property to underwrite and protect the loan dollars, they're not going to be as aggressive for the amount of loan they will give you. So I mentioned debt coverage ratio. Generally, when we're doing loans, we're going to have really 3 different tests that we'll do. For those who've been through the CCIM curriculum, we've gone through that of what is the LTV, what is the total value divided by the loan amount, percentage of that value. You've got your debt coverage ratio, which you take the interest rate and figure out based on a 30-year or a 25-year or even a 20-year amortization what the monthly mortgage or annual mortgage payment is going to be and what is the relationship between that number and the net income from the property, which is taking your total gross revenue, subtracting the operating expenses, you get your net income. So it's going to limit that. And then you'll have also your debt yield, which is kind of like a cap rate for loans. It takes your net operating income and divides that by the actual loan amount, and you get a percentage that is independent of what the interest rate is. So it was used by lenders really came about in the recession, where it became much more widely used there. But today, if a lender tells you they're going to give you 75%, 80, or 50, even 70%, what do you say?
Is there enough debt coverage?
There has been, there's been some adjustment to cap rates, to rates used to value properties, but nowhere near, if we've seen 25 to 50 basis points movement in cap rates, that is just a small fraction of what's happened to interest rates. So, like looking at loan to value, looking at debt yield right now, it's almost irrelevant. And again, if someone comes to me and says, I've got this deal and we can, it underwrites to 70 or 75% of the purchase price or the value, you're like, what's wrong with it? Because there is something. But
Right now, we are highly constrained by DCR. In general, we can go up to 75% loan to value, 75% of a purchase, but with rates the way they are, we're probably in the 68 to 72% range on most of our deals, and sometimes less.
Bob?
Yeah, we're very similar, even though we're private money. We're looking at cap rates anywhere, I've seen from 4 to 9%, depending on the property. But we're keeping the loan to values at 70% or under. We will go higher. That's the benefit in our business. We don't have to worry about reserve requirements and things like that. But what we're seeing is the banks are constricted because they're looking for 1.25 debt service coverage or higher, and some are 1.35. It just depends on bank policy at the time. It's like an accordion. Does it expand or does it contract? I don't have those same issues or constraints in my business.
But you're still going to be looking at how do you get taken out.
Absolutely. Always looking for the exit strategy.
And that is going to be usually one of these two or another bank, and they're going to have that restriction that says, yes, I can give you 85% of your the cost into this deal, but once you execute your business plan, you lease up these vacants or you do whatever it is you're going to do, we need to look at that proposed or that projected NOI and make sure that there's enough of that at an appropriate interest rate that there is an exit for Mr. Bridge over here, because he doesn't want to hold this longer than a year or two.
Right. We're 1 to 2 year. That's it. Then there's going to be pressure. Kindly.
So one of the pieces that we're seeing, and I think that we will see more of, is that component of the market where we have put, especially here in Vegas market, in the Phoenix, Arizona markets, there is a much higher proportion of the floating rate debt bridge, of the value add deals that were taken down, and with the expectation that cap rates are never going to change unless they go down, and interest rates, well, they'll go up a little bit maybe, but we really like our 3.5% interest rate, so this makes sense. We can make money all day long. Now, we've got problems, because that same loan that was at a 3.5 or a 4% interest rate, maybe it was even at a 5% interest only floating rate debt, now has to be taken out. And where do those go?
Cash in refinances. They'll go to us. We will underwrite the best we can, but a lot of stuff that we're seeing is cash in refi.
Or a sale, with a new buyer who brings new equity.
Well, and perfect segue, because we look, and I know there's a number of investment sales people out here, but everyone knows investment sales are down significantly, and but the one place that we do see some sales activity happening, in particular in the multifamily space, is buyers who bought in 2020, 21, and they used, SOFR was 4 basis points, and so they went out and they got in 75 to 85% debt fund, high leverage, floating rate deal at
SOFR is now 530 basis points, for reference.
So SOFR plus 350, And they did called it a 3-year deal with a couple extension options. And the lender at the time said, okay, well, you've got to buy an interest rate cap. And they said, okay, well, I don't want to buy it for 3 years because a 2-year cap is so much cheaper. And the market was hot and pressure was on lenders, and so lenders started moving to, okay, you go buy a 2-year cap, and then we're going to make it a recourse requirement that you buy that 3rd year when it comes due. And so they have a $30 million loan, and they bought a 2-year cap, and it cost them $25,000 because SOFR was at 4 basis points, and so they budgeted $25,000 for that replacement cap 2 years down the road. And well, 2 years down the road comes, and that $25,000 they have budgeted for that replacement cap, the cap now costs $1.5 million. And so,
or more.
Yeah, and so that's where we're actually seeing some sales activity happening. Is these caps are coming up, and buyers who bought multifamily in Vegas or Phoenix, at a 3.5 cap in 2020, 2021, are looking at these huge replacement caps and saying, if I can get out close to where I bought this for, I've got to get out of this because I have too many of these replacement caps coming.
We have a situation very similar to that. We actually took out a bank, and debt service coverage was 1-to-1. They couldn't get refinanced through the bank without paying almost the same interest rate that we charge. And our rates have not changed with prime or cost of funds or Fed funds. We're at anywhere between 11 and 14%. I know that's high, but I've got to pay my private investors. So
And when bank rates were 4%, you were 11 to 14%.
the same. Nothing's changed. It's not that sophisticated.
And why don't you change? I mean, it feels like you could.
Because we can still raise the capital, and we want to attract better borrowers. And we are getting bank-type borrowers. A deal that we're closing on, we closed on the land portion. I'm doing the construction now. It was a bank customer of mine when I was in private banking. And so, like I said, those relationships are so important. When he found out that I had moved from the bank into the private money, he called me up and said, I'd like to do some business. My bank moves far too slowly for me, and I want to get this thing. I want to acquire the land. He had a time limit. He was buying it from D.R. Horton, and he had a very stringent timeline. We were able to close on the deal very quickly, and now we're doing construction financing on the property.
So if it doesn't end up where, I guess worst case scenario, if one of those properties has a large loan on it or any size loan on it, but it is not performing at the level that it needs for a takeout, and God forbid it is not performing at a level that is capable of being sold and making the lender whole, so it's underwater, what are the options? We're seeing some of those types of loans being pretend and extend, or where you will give them another 12 or 24 months in order to hope that interest rates or expect that interest rates are going to be lower and make this work again because it's primarily an interest cost. There's nothing wrong and inherent to the property. But what's your approach to that type of thing?
Right now, take a look at each deal on a case-by-case basis, figure out what the borrower's plans are, and most likely a 12-month extension to see what can get done and where we will be in the next year.
Yeah, the private money's not immune to any of this. We've seen it. We've had to extend things beyond a year. Just now, in one example, the property's for sale. We're hoping the sale happens. It's still performing because I have an interest reserve built in, but when that runs out, there's going to be a shortfall. We were 1-to-1 when we did the deal, or 1.25 debt service. Some tenants moved out. It's put all of us in a bad position, so hopefully they're in a position to sell the property. That being said, we lent $18.85 million. The property value was $27.2 million when we did the deal. So they've had offers at 24, 25 million. They're going to be in a position where they're going to have to take one of those deals.
When we're looking at the types of loans that you guys, or the types of properties that you do. The banks are still active out there, especially when you have strong relationships, which means deposits, because the banks can use that toward their capital requirements and lend money out on what their deposits are. So that becomes a critical factor when you go to your bank, of, especially if it's a newer relationship, how much deposits can you bring to the bank as a result? For very large, very well capitalized institutional borrowers, that is still an option for these headline trophy types of properties. And if you have a multifamily or a industrial Class A, Class B, you're going to find multiple term sheets on that from these guys as well as from banks, most likely. Where is it from the alternative sources that you really shine? What types of properties can you deal with, and how do you deal with that, if so, that the banks would not be involved with?
There's a lot of times that a property has a story. The borrowers owned it for a while. They had a bad property manager. They lost some big tenants. They just got a new tenant in, but there's no history of that tenant making payments yet, so the operating history looks a little bit spotty. We can get comfortable with that because we do have recourse, and we look to the borrower and their net worth to help along with that.
And their past experience in doing that kind of thing,
Yep.
perhaps?
I believe that banks at one time would not do any land whatsoever. And a large portion of our portfolio is in land acquisition and land development. And I think that's where we come in. We're at the front end of the food chain on a lot of these deals, and there's risk in that. So we are certainly seeing times when they can't get construction financing, so we've got to go out to the market and see what we can do.
And you even said you did an office loan, which has made headline risk recently in the last 6 to 12 months, or even post-pandemic, seeing the storm clouds brewing there, but it's still something that you look at.
We'll still take a look at it. Yeah, we've got investors that have different appetites. Some people don't like construction. Some people like construction. Some people like land. Some people want to take the whole deal down by themselves. There's no co-investors. It depends on the deal. That's why we'll look at it. On the phone just here, when I got here today, I had to decline 2 deals that had come across my desk over the last week, and they just didn't make sense for us. I didn't think it'd be good for our investor base. Our allegiance is to our investors. That's primarily how we do business.
Either of you other guys do office?
We will look at office. It helps that our maximum loan size is 20 million. So we are typically suburban office, garden, walk-up, things like that. Smaller users, not huge floor plates. It's not an automatic no, but it's definitely a little bit harder right now. So it's probably not going to be as much high as LTV that the borrower wants. Definitely no cash out. And I really hope the rent roll looks pretty decent.
Yeah, we're still doing office. Again, it's got to be the right office. It's got to have a well-diversified rent roll. Can't have a lot of near-term rollover. It's got to be well-structured. I think the phrase I heard was, if it's not a cash in, it's a cash out. But if you look at the CMBS universe, if I look at the last half dozen securitizations that have been done, they range from 19% to 26% of those pools are concentrated in office. So the right office deal can get done, but there's a lot of office deals that have, very lumpy roll, have a lot of near-term rollover. Those deals have some pain.
And those deals are done at a premium rate to an industrial or a retail type of deal.
Definitely.
It's not I would say in CMBS, it's not a gouging rate, but there is some premium.
Is that
25 basis
25?
That's where we are too.
Also 25, right?
25.
Yeah. So that,
I think that's a poor reflection of the risk premium differential between multifamily, industrial, and office, but
that's
so.
the market right now.
Yeah.
Okay. Where are your general rates? Bob has said he's in that 11 to 14%, depending on the leverage and the risk and the type of property. Where are you guys ranging for your deal types?
We're in the low sevens.
Okay.
CMBS is, call it 7-ish% for 10-year money, touching up to 8% on 5-year money. Agencies, Fannie Freddie are, we've got a 460 Treasury today, so call it low 6s on 10-year money, and kind of into the mid 6s on 5-year money.
And where was that 12 months or 24 months ago?
Well, 12 months ago, so we've had 10-year treasuries up 90 basis points over the last 12 months. I think the 5-year treasury is up 110. Spreads are in 25-ish basis points.
Okay. But that also the treasuries 12 months ago, they had peaked and come back down. So
Yeah.
the swing in the last 12 months has been more than 90 basis points.
Yeah, if we look at from January 1st, 2022 to today, that 10-year treasury is up 400 basis points.
That's a big number. Betsy, how much have you changed in the rate-wise in the last 12 to 24 months?
I think we were in the low mid 4s 12 months ago.
I had a 25 basis point premium on hospitality with you at 5.25.
So yeah, we were mid
That
4s.
closed 12 months ago.
Yeah.
So we were in the 4s. And you were in 11 to 14.
But it's funny to think that in 2020, when we were coming out of COVID and everyone was starting to lend again, and there was some risk premium, at least for us and for Betsy. We had some deals that were eclipsing 4% in the coupon, and you'd get this look from borrowers of just like this, the audacity of you to quote a 4% coupon. Different world.
At the end of 2020, I closed a here in town office property of 3 different buildings, 10 years interest only at 3.08%. That was the low point and will probably always be the low point interest rate wise of my career. Maybe it goes back to that. My problem with that is if we do go back to such a low interest rate environment, something else has broken to a pretty bad extent and will cause much deeper dislocations. So as we talked about asset classes, are there types of assets that are not being lent on or that you guys are unable to lend on today?
There's something that we're not able to lend on. We're just being very cautious with office. We're not doing much hospitality, and we don't do anything special use, I guess, with like a golf course or super special use like that. But everything else, we're open to looking at.
Okay.
Same. Again, we don't do golf courses and single tank gas station types, but the main food groups, and then you add in self-storage, manufactured housing, hospitality. All those are very much open for business right now.
So as we're, I want to get more onto. We talked about how the lending market has changed. How specific to the Las Vegas market is there a premium to the rate or a discount that Las Vegas sees that compared to the rest of the market, like, oh, that's the Vegas, we're not going to do that, or we're going to do it, we're going to get paid extra. How, from a national perspective, how are we looked at compared to other surrounding markets? Is there a difference?
We don't treat it any differently than any other market.
That's the right answer.
We love doing deals here.
Yeah, I think the maybe a little attention gets paid to office and to some of the value add multi in Phoenix and in Vegas, and like the cap rates just got really tight on some of the multi that was being done. That was that light value add on 80s and 90s vintage product. Like, so there was maybe not concern over the market, but concern over rent growth projections in multifamily, that you just felt like, I mean, rents in the market were going like this, and borrowers were coming to us saying that, like, yeah, they're going to go like this forever. So
Numbers
just
always go
model
up,
that.
except
Yeah.
interest rates.
Just some caution that, markets where rent growth has been so tremendous over the past 3 to 5 years, just got to keep an eye on those.
Yeah, and I was reading in TREP this morning that there was a larger multifamily property that traded in SoCal for a 3.98 cap rate still.
Yeah, you'd still have a hard time in LA, Orange County, San Diego, finding, like if you said, I want a new Class A build, stabilized multi, you'd say, I'll buy a 4 cap, your phone's not going to be ringing from sales brokers.
That's fun. So one of the phrases that's been thrown around within the commercial real estate profession side has been the stay alive to 2025. We have the mantra within our office that surviving down cycles is winning, because it tends to wash out those who are not well capitalized or stable. How does that affect, from your perspective, on the commercial real estate lending? Do you guys thrive in these markets? Do you survive, or does it start hurting to where there is long-term changes made going through these down cycles, or just troubled issues?
We are actually having a record year. We are picking up a lot of borrowers that have come from banks to us for various reasons. We're on track to have the best year this year, and we're gonna do a little bit more next year. We have heard the survive to 25, and I was gonna comment earlier, kind of with the rates, we're just doing what everyone else is doing and waiting to see what happens. I'm here, I've worked with Comcap for about 10 years. We were in the market yesterday doing a market tour, talking about everything that's going on. I talk to these guys every day, or at least a couple times a week, and we talk about what they're seeing, what we're doing, what we can both do to try and get some of these deals done. So for us, it's just gonna be constant communication and working together.
When you look at what's happening in the next year, you've got an election cycle. You've got 435 House seats up for grabs. You've got 33 Senate seats, and you've got the presidential election. I think a lot will happen after that. I think things will start to slow down. Things have already started to slow down for us in terms of raising money, but I think it's going to be critical what we see in the next 12 to 18 to 20 months before we really understand where we're going with this. Meaning, you can be in a recession for 12 months and not know it. We've heard that before. Who knows? But I think the election cycle will certainly have an impact on where we all are in a year and 2 years and 3 years.
Yeah, and the good thing is that the markets are not influenced by politics whatsoever, so we're okay with that. So that covers the majority of the questions or the topics. We have a few minutes for Q&A. If there are burning questions regarding to the market perceptions, or it's not a time for, can you do my deal? You can come talk to me afterwards and we can discuss that. But if there's questions for any of these individuals, this can be the time.
Hi, Ophir from Berkshire Hathaway, the Barashi Group. Thanks for coming. My question was specifically about financing land acquisition. I know that that's just not a very common thing. I know private equity is probably the only route, but I was curious if there are other options aside from private equity. Do you guys also finance land acquisition?
KeyBank does not typically. It's got to be a very, very, a lot of stars have to line up from a relationship standpoint, but banks do. Yeah, I mean it's again, you're not going to have banks beating down your door this point in the cycle, I don't think, but it is a bank product for the right relationship.
And they do that with the expectation that there is a back-end development going on it. They're not interested in the land banking. I want to buy this and hold it for appreciation.
Exactly. It's got to be land acquisition and development, whether it's earthwork, ground up, vertical,
Entitlement.
horizontal. There's
Yeah.
got to be something going on to the property. But we'll definitely take a look.
Or higher.
Exactly. You can become an investor for 12%. I've got no defaults yet.
How's the lending environment on office conversions to multifamily? Is that still progressing, or are you guys still being cautious about it?
From office to multifamily,
Office conversions, like,
it has to, it's being done, but it's like they said, it will be considered. It's going to be a bridgey product, so that it's a higher cost to that because it's not going to be one of the banks. It's not going to be one of the institutions who does it. It's going to be a private solution. So that's going to be double-digit interest rate, if not mid-double-digit or mid-teens.
We have actually done some motel to multifamily conversions.
On the balance sheet side?
On the balance sheet side, with a, kind of a traditional bank bridge type product. But the office to multifamily conversion is a tougher, it's a bigger lift. So it's probably, more of a non-conventional lender that chases that.
And yeah, you have to deal with multifamily. Going to multifamily has a whole lot more plumbing. It has, there's a lot of things that go into the floor plate. So each deal is very specific.
You gave us interest rate ranges, but never heard about fees. And it's my understanding on the private side, the fees are pretty high.
Steve.
Hi, Bob.
And that's a negotiation point as well. We're finding that borrowers are smarter. They're coming to us and asking for a reduced rate. They're coming to us and asking for, will we assume an appraisal from another lender that may have engaged it? We typically charge 2 to 3 points. We keep 1 point off the rate. So if our note rate's 12, the investor will get 11. And then we service everything in-house. I don't use a third-party servicing agent because I want control of the funds. And we're the only private money lender that I know of in Southern Nevada that has an audited financial statement.
We charge a 1% commitment fee. We do collect a 1% good faith deposit that is refunded at closing. Out of that good faith deposit, we take an appraisal fee and a phase 1. We don't require a PCA, and we don't use legal to close. We do everything in-house.
On the CMBS side, we are generally a par lender, so no origination fee there. On the agency side, the Fannie and Freddie have required minimum fees that any seller servicer with Freddie or DUS lender with Fannie is required to charge, and those fees depend on the loan size, and it's anywhere from 25 basis points to a point, depending on the loan size.
And that's non-inclusive of transaction cost, third-party reports, and
Correct.
lender legal.
Yeah. And CMBS and agency are going to have kind of your full third-party reports and outside counsel. I will also say we, like Bob, we KeyBank services every loan we make, whether it's CMBS, balance sheet, agency, our debt fund, everything's serviced in-house. We've got about a $500 billion servicing book, so we know that clients value that after the fact, the touch point, and ComCap is one of our servicers here in the market. So every loan you do with ComCap through Key, ComCap is involved in servicing.
And we're the same too. We service everything with the help of ComCap.
How big is your portfolio?
$15 billion.
15 billion. Okay. Well, I think that is all. Thank you for your time and for coming out to speak with us.
What a great panel.